What the crazy volatility in the stock market and Bitmine, guys, okay? But this volatility is your friend. How many times you have thought when the other week we were at 65 from 39 and you were thinking, well, damn, I should have bought more Bitmine. Now it's back to 45 and now to 52, and now you are sitting there and thought, man, I should buy more. And this is the beauty about volatility. It's your friend. And in this vlog, we will talk about the volatility. We will talk about corrections in the market. We will talk about how volatility helped me in my biggest investments. All about that now on this vlog.
Welcome to the game. I'm the wolf of Dubai.
So welcome to a brand new video. As many viewers are not subscribed, this is my main channel. My second channel is here, Wolf of Dubai 2. Subscribe to both and check out my x10daytrading.com, which is my own product where we trade for you with our AutoPilot software. We made money this week, even it was a red week, so we can day trade options and make everyday money, or even in uptrends and downtrends. That's the beauty about day trading, but it's all done for you with our software. So if you have $10,000 or more, check out the link and schedule a call with me personally, and we will see if we can help you as well. Now, volatility is amazing. Okay, volatility was there in my very big Tesla investments, and I will tell you all about it right now. So I invested my life savings into Tesla. You can actually go on my YouTube channel. You can go to my very first vlog. It looks horrible, but I was there and I was comparing the valuation of Uber and Tesla, and I said, like, I'm investing a lot of Tesla. I had crazy price targets. People called me crazy, same like they do on Bitmine. And now, who is the crazy one right now? Okay, so what I did was the following. So around like $17, I bought Tesla shares. Okay, you know, and then there's, I don't know if I can zoom in here, but it was a crazy ride where actually Tesla, I think it was here actually. Yeah. So then Tesla actually dropped quite significantly. I think it's not properly here shown, but the lowest that Tesla got was like $6 after I invested. Okay, so, and then I was thinking, well, what I do? Do I go out of the investment? It's my life savings, right? But I said, no, I'm very convinced that this company will be successful. And there was no good news about Tesla at all back then. Okay, this was like really crashing on Elon Musk, that he will go bankrupt, that China will never work, Model 3 will never work, and so on and so forth. And then everything changed. Then they did what they promised and the stock went through the roof, right? So we saw then the 2020, 2021 times until 300, you know, and then we had another big correction, and then again we went on another 200, 300%, and so on and so forth, right? So volatility is totally normal. And because my subscribers back then followed me on my Tesla investment, they bought houses or even apartments. So it was it's a very good return of investment to be subscribed with me. Now, let's dive into Bitmine, okay? So Bitmine had a crazy week as well, okay? So we actually, this week, were starting a downtrend. Okay, so the highest we were was on the 22nd of September, which was around 60, and then we lost about like 20%. Okay, technically we were until today in a bear market, because technically if you say like the stock goes down 20% or Ethereum goes down 20% or this market goes down 20%, it's a bear market. But bear markets or a bear trend can stay for a very short term, specifically for a company like Bitmine. Okay, because Bitmine is obviously very, very, you know, tied up to Ethereum. And Ethereum actually had also a pretty bad week, okay? Also, Ethereum lost about in the highest, like 14% this week alone, right? And then we started a small recovery from the lowest point to where we closed on Friday yesterday around like 5%, okay? So, but you can see even just today, Bitmine, I think, had a move of 7% intraday. Okay, so here is it. You can see at around like 10:30 until later in the evening, we had a 7% move, okay, which is crazy, okay? So, and the very first time what I have seen also, there's two things this week with Bitmine. The first thing is that Ethereum dropped and Bitmine didn't drop that much. And on the other hand, Ethereum went, today like 3-4% and Bitmine just made 2, right? So it's kind of interesting, but volatility is always your friend. Volatility offers you a lot of opportunities. If you want to trade in and out of this stock, a stock never goes in a straight line up, okay? This never happens, okay? And if this happens for a very short-term period, it drops, like we have even seen in Bitmine, where it went from $4 to 160 and dropped all the way to $30, okay? So this doesn't exist on the markets, okay? So you need to understand that volatility is great. Also, the third point, maybe it's also great if you write, for example, calls or sell puts, right? Like you can use that volatility as well. And it gives you a longer time to accumulate a position that you really want for Bitmine, okay? So this is very important. And I want to show you a clip now. And this clip is by the legendary billionaire investor, Peter Lynch. And he will explain you what he thinks about volatility.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I think I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1, and it was the largest position in Magellan in 1978. When it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur. Markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that, because profits will go up 8% a year and stocks will follow. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years. About once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
So as you can see, even I really like style, because like he not only turned like $13 million into $18 billion over 13 years, but also he explained things very funnily and very easy. Okay, so this is quite important. That volatility is just there and it will always be there on the markets. It doesn't have to be even something to do with Bitmine. It can have something to do with the market. And currently, there's 3 things. First, we are quite over overbought, okay? Second, we had the September rally, which is not in the seasonality, okay? The seasonality actually is that September and October are weak months, very volatile months. This didn't happen. We had a straight rally. So obviously at the end of September, algorithms, institution, hedge funds, and so on into this quarter, they are selling, they are securing profits. So we will definitely see the next couple of days, maybe some more profit taking over the next couple of trading sessions. And the last thing, guys, there's always macroeconomic data, there's geopolitical data, there's Trump tweets, there's so many other factors that can impact the overall market and keep all the boats up or all the boats down. Okay, so remember that stocks can go up and they can go down. Okay, so but in this environment, trading is really great. So if you want us to trade for you into your portfolio, if you have $10,000 or more, check out extenddaytrading.com. And now let's dive into the second clip. I prepared a clip for you from one of my most amazing idols of the stock market, which is Charlie Munger. Okay, very simple investment style, more to the value side. I'm more like a growth tech investor, but he is more into the value side with Warren Buffett. Obviously, he died unfortunately, but we can learn a lot. Here's a small clip to watch.
He'd say, swim as long as you want, but stay near the shore. Well, but you can laugh, but
No,
he was a very wise man.
exactly. Yeah.
But what I'm hearing you say is that you, as a discipline, look at what the risk is on the other side of the situation, and you avoid that. That's one of the rules.
Well, it's just it's like a lot of practical problems in algebra. If you invert, you can solve it easily. If you don't, you can't solve it easily.
Exactly right.
And so, of course, I had that trick very early. And most people, they say, how can you please tell us what you do to save India or to help India? And of course, I would approach it differently. I'd say, what could I do which would most easily hurt India? And approaching it in reverse that way, I got better results.
You look at the vulnerabilities.
Yeah, yes. And I have a whole bag of tricks like that. I went to the ROTC, both in high school and college. And the ROTC taught me to fire mortar shells or artillery shells, one shot over, one shot short, and then kapow. Well, I never shot any damn shells, but I've been using that mental trick all my life. That's how I determine what size to make something. Over and under and kapow. And so I just got a bag of tricks. And I got the right bag of tricks early. And of course, it's been of enormous help to me. Let me give you an example. I had a client once when I was a young lawyer, and he owned a bunch of hilly ranch land on the edge of civilization, not very far from here in Southern California. And the Edison Company came through and they wanted a new easement through his land. They already had some easements. And he hired the leading appraiser in Orange County, real estate appraiser, and said, and he had the idea that he should have $250,000 for this easement from the Edison Company. And this leading appraiser, who was very pompous and very old and very distinguished, and he told him, no, I'm sorry, it's only $125,000 value in your damn ranch. And so he came to me and said, Charlie, can you talk some sense into this elderly appraiser? And so I looked at his problem and I told the appraiser what I thought how he was doing his own appraisal wrong. I'm not a real estate appraiser, he is. And what he had done is what he was taught to do in appraisal school. He thought the problem through in two dimensions, and he figured out from comparable sales what the value per acre was, and then he computed the acreage, and he had something a little bit on the damage the easement would do to the remaining property, and so, but it was all done in two dimensions. And I said to this appraiser, you've got to do this in three dimensions. You know, God gave us three dimensions. And I said, if they put the utility towers, big transmission line towers, which is why it's going to freeze the grade. And the logical way to develop your land is to lop off the top of the hills and put them in the valley. That's the way hilly land is developed, and they're doing enormous damage to you by freezing the grade. And he said he wouldn't change a damn thing. So I said to my elderly client, I think you have to fire this twit. And I will hire you an appraiser who can think. And so I got him $600,000, which wasn't at all hard because I was dealing with a bunch of honest engineers at the Edison who did think in three dimensions. But again, that's so simple, but you'd be surprised how many lawyers would screw that one up. And of course, people like that appraiser, who didn't know his own business very well because he didn't pay attention to the fundamentals. Those people are always with us. And if you just have the mental trick of constantly going back to the basics, it's pretty basic insight that
Are you conscious?
the geometrical problem in a real world is three-dimensional.
Are you conscious of the rules, or they're just there?
Well, it's so habitual with me.
Yeah, I understand.
And I revolve possibilities and I rag problems hard. And if they don't yield, I come back. And so this is just a bag of tricks, and it enables a non-prodigious man to get prodigious results.
So as you can see, what I really like about Charlie Munger, he said the following. I don't know if it was in this clip, but in this clip, he explains that it's very important to understand its risk, okay? If you say like, hey, I invest into a crypto-tied company, then you should understand that Bitmine will be very volatile. Same like crypto, okay? Same like Charlie Munger said, his father said, like, you can swim as much as you like, but keep close to the beach or keep close to the shore, okay? So this is quite interesting, and that he takes this simple stories and apply them to the stock market, which is quite interesting. The last clip is, by the way, about Tom Lee. But before we diving into that, I want to also share with you one story where Charlie Munger said, to be successful, think about what would happen for you, what if you do those things, you would be not successful. Like, for example, you try to, buy in and out Bitmine, you don't hold for the long term, you only see the negativity, you are bailing out for every 20% down day or week or whatsoever, you don't believe and you don't buy the dips, right? All of these things. And then turn it around and say like, okay, if I don't do that negative stuff, then the outcome should be net positive for me. So you actually turn it around. And I think this is quite interesting. So the last clip is by our chairman, Tom Lee, and he is currently on tour in Asia, Singapore, South Korea, and he's actually on stage sometime and talk about funds trade and his investment principles. And he said the following. This is brand new, and I really love that, because most probably the next couple of days we will see a lot of new content by Tom Lee, and I will make sure to cover that on both channels, so make sure to subscribe. And now let's dive into his 7 principles of investing.
This is our several sort of general principles that we use when we look at markets. But I think the one thing that I want to just highlight here first is line number 4, which is it's really important for people to stop carrying a Lehman Brothers hammer, okay? And what I really mean by that is we all are wired to have a cognitive bias, okay? And what it just means is our brains, when they see something, they're always trying to interpret it for actually self-preservation purposes to something that we all know. And because that's what happens to our brains, we tend to think something might be there that's not. And I'm going to give you some examples. So first is this idea of called the law of the instrument. I'm not sure if you heard it, or it's also called Maslow's hammer. But it's the idea that if someone gives you a hammer, you're just going to be looking for nails. And that means if someone's lived through the GFC in 2008, the great financial crisis, they're assuming everything's a Lehman Brothers event. And that played out a few weeks ago, as you guys remember. We were saying this was from 2 weeks ago. I didn't put the date on here, but when the Evergrande debacle and the potential debt default was sort of making the headlines, there were a lot of people who were experts saying this was the Lehman event and it was going to trigger another crisis. And we just put out a tweet just saying, be wary of Maslow's hammer. Too many people carry doomsday hammers. And as you can see in our little GIF, that hammer is blowing up on them. Ouchie. But here's another example of a cognitive bias. This picture looks like a color picture, right? I mean, you guys look at it and you can see blue and yellow and red, like someone's wearing a yellow t-shirt, green t-shirts, right? It is actually a black and white picture with a grid. See? But what happens is those little lines make you fill in the entire shirt. Instead of someone saying that's a gray shirt with blue lines, they see a blue shirt. That's how our brains work. We see a little bit of something and we assume that's the whole picture. So I think it's super careful that when you look at the market, a heat map, just be aware that you could be applying your own bias to what you're seeing. That's how, we emphasize to our team of 29 research people at Fundstrat, don't carry Maslow's hammer.
So as you can see, he basically says like, don't treat everything as a hammer, okay? So what does it mean? For Bitmine, I think it could be interpreted in a way where, think about that, okay, someone once, saw a downtrend and then he saw a stock failing or a company failing or not coming back. And every time this person sees such a drawback of, 10%, 20%, he always anticipates that with that experience that he had. Or maybe even simpler. Imagine you are married. You have a guy, or you are the guy and you have a wife, okay? Now, I assume that this person, your wife or your husband, is not the very first person that you ever met or dated, right? And just because it doesn't work out with your first person, you never said, oh, you know what? Girls are not for me. Or, you know what? Boys are not for me, right? You kept on trying. So just because you buy Bitmine and it's going down, don't be freaked out and say like, oh, this is not for me, or this is not going to work. Statistically, just by the statistics, 70% of the time the stock market goes up. And we had lots and lots of corrections and even bear markets and even drastic crashes over the last couple of years. And every single time we went up to all-time highs. And this will mean all-time highs for Ethereum, and this will mean all-time highs for Bitmine. And you remember what was the all-time high for Bitmine? Yes, 160. And I think we have a very, very good chance to get new all-time highs this year.